The Fed institutionally believes that they're the only arm of the U.S. government that stands between the U.S. dollar and the abyss. The Fed believes that and I think accurately, that there's no discipline in the executive branch and there's no discipline in Congress. And I think that the Fed's bias would be, rather than to raise interest rates, allow the market to continue to take the long rate up and drag the short rate with it, which the politicians are desperately afraid of. The interest rate reflects, really, the collision between the interests of savers and spenders. Artificially low interest rates, which is what the political class want, punishes the savers in favor of the spenders. Politically, there are many more spenders than there are savers. So from the point of view of the politicians, who are probably less interested in the economy and more interested in getting reelected, pandering to the spenders at the expense of the savers is political, and that's precisely what Trump is doing. Sorry for this long-winded answer. I am old enough to remember the decade of the 1970s. In the middle of the 1970s, inflation became an issue, and the Fed allowed the interest rate to rise, trying to keep pace with inflation. The impact of that increase in both nominal and real interest rates was to crater the price of gold. It fell by 50% in 9 months, but also to crater equity markets, obliterate the long bond market, and put a hell of a dent in the housing market. When Congress and the Fed capitulated at the end of 1975 and manipulated interest rates lower, that was a signal to the world economy that the U.S. government didn't care about the U.S. dollar, that the game was over. And between the end of 1975 and the end of 1981, the gold price ran from, if my memory serves me correctly, about $100 an ounce to $850 an ounce. I think that engineering the removal of the Fed chief and the political manipulation of interest rates lower could have a similar impact on the gold price. It would represent the capitulation of America's political class with regards to maintaining the purchasing power of the dollar.
The Fed just did it again, this time without saying a word, quietly backing away from interest rate control while Congress doubles down on reckless spending. Rick Rule warns this exact setup already happened in 1975, and gold exploded 8 times. Today, the signs are back. Real returns are now negative by 3%. The purchasing power of the dollar is set to collapse by 75%. And yes, that's an official government projection. This isn't theory. This is the final act of financial engineering, and gold is the only asset that isn't shackled to the system they're rigging. But here's the part they won't tell you. They're already sealing the door behind it.
I think the U.S. dollar will do relatively well, less well than in the past, but relatively well against other currencies. But I think if you're an American saver and you're interested in the absolute purchasing power of the U.S. dollar, I think that the U.S. dollar in absolute terms will experience a 75% decline in purchasing power over the next 10 years. Very much what we experienced in the decade of the 1970s. By the way, that 1970s number isn't a Rick Rule number. It's a number offered up by the Office of Management and Budget. It's a government number. I think that what we experience in the next 10 years will resemble in that regard what we experienced in the decade of the 1970s. I think it's arguable, and I'm no economist, I'm not, I'm a credit guy, so let's get that on the table. It's arguable that the current softness you see in the prices of things like nickel, nitrogenous fertilizer, oil and gas, suggests that the overall economy is weaker than people think. The oil and gas price in particular, given the weakness of the U.S. dollar and the fact that oil is priced in U.S. dollars, and given very flat production profiles, the fact that the dollar price of oil and gas is soft tells me that near-term demand is lousy. So it could be that whatever positive impact, nominal positive impact, comes to commodity markets from inflation will be delayed because of a softer global economy. Gold, very different story. I have an awful lot of cash, which would suggest I'm cautious about something. I'm not sure what it is. I believe that we're coming into a period that's going to see a lot of volatility. And the headline risks that we face are fairly high. That means I think that there's a possibility, as opposed to a possibility of a 2008 style liquidity crisis, a confidence crisis. And I'd like to be ready for that. I understand perfectly that my US dollar savings at the interest rates I'm getting paid means that my purchasing power is declining. Getting paid 4.5% in the 10-year Treasury in a currency where the purchasing power is declining by 7.5% compounded means I'm losing 3% a year. But I consider that negative interest yield to be an option premium on having cash available in a liquidity squeeze where other people are victimized by it and I can benefit. If you're at a wealth building stage, if you have the ability to, invest first in yourself and build your own business. Worry about your portfolio after you've done that. Build your brand, build your knowledge. Do that. Even if you're working for somebody else, build your ability to contribute to the utility of other people, because that's how you get rich. In terms of the portfolio, it's very difficult for me to understand why more individual investors don't own gold. In the circumstance that looks most likely to me, which is the continued deterioration of the purchasing power of all fiat currencies. That circumstance has historically over time, and I'm talking about over thousands of years, benefited gold. A little bit of gold goes a long way too. In the decade of the 70s, the gold price ran 30-fold. I'm not suggesting it's going to run 30-fold from here, but it's already up 10-fold in 25 years. In other words, it's done its job. A 10% holding of gold in a portfolio can hedge a hell of a lot of sin elsewhere in your portfolio. I would not personally own bonds with duration longer than 5 years, because inflation obliterates bonds. The money that you get back is worth less than the money that you gave them. And the capitalized value of the distributions goes down as the interest rate goes up. So I sure wouldn't do that. I also would trim any debt you have on the balance sheet, particularly any debt that's floating rate. A 30-year fixed mortgage, that's very different. Borrow money for the long term where your cost of capital is fixed and your return on capital employed can grow, which is to say borrow money to buy rent. That's a good thing to do. I would also ask people whether they're building or protecting to invest before they speculate. If you think the gold price is going to go up, you begin building your gold portfolio after you've bought gold itself by buying the very finest gold companies in the world. Once you've done that, once you've bought the market beta and de-risked your portfolio operationally, if you're willing to work, really work and study, then you can speculate. But if you're not willing to work, do not speculate. I'm also, with regards to broad markets, I don't know enough myself about sectors outside natural resources and financial services. And so I don't do much that I don't understand. Many people advocate buying the S&P 500. And probably if you have a 30-year horizon, that's okay. Most people don't. For me, the S&P 500, 40% of the market cap is made up of 7 companies. And they're big tech companies. And I don't know how to know if they're fairly valued or not. So my own general market securities portfolio is pretty much constrained to shipping companies, which I know a bit about, Berkshire Hathaway, which I've owned since 1982, I figure I can't outguess Buffett, particularly when his portfolio is in an insurance wrapper that limits his tax, and an ETF called the Dividend Aristocrats. Very high quality companies that have met or exceeded their dividend guidance every year for 30 years. Not a particularly aggressive portfolio, but it is a portfolio that while I might not be happy with it 2 years from now, almost certainly be happy with it 5 years or 10 years from now. And despite being 72 years of age, I am still a relatively long-term investor. People in the protection mode probably need to constrain themselves to companies irrespective of industries with very good balance sheets that are generating substantial free cash and that are generous enough to distribute some of that cash to owners. My friend Doug Casey once described earned dividends as, quote, outward manifestations of inward grace. And I love that quote. So people who are protection-oriented need to focus on those fortress-like balance sheets and income statements.